Now, here's the cool thing. Let's just say that my practice is at 400K. Shoot, I don't get that deduction, right? I miss having this free money. So now the game you go is just say you play the game is, okay, what deductions can I take now to get below that 350 threshold? So you get double benefit for it. If I'm at 400K, I'm going to go find myself $50,000 of deductions, and I'm going to pick up another 60K deductions because now I qualify for the new 108 deduction. That's where you start doing some income modeling, right? We do that with our clients every year in around October. And we say, hey, go buy this. This is your number. You want to go, hey, go shopping. But go shopping for stuff that's going to make you money. You need a new scanner. You need some new hand pieces. You need a new chair. You're going to expand to the 5th op. It's going to pay for itself because you're right there. You're basically don't.
Welcome back to another episode of Dental Marketing Theory. I'm your host, Gary Bird. I'm the owner of SMC National, where we help offices just like yours level the playing field against the big guys out there, so you can grow the way that you want. But it's hard to grow when the government is taking all of your money. Today, I have Omar from Virjee Consulting, who's going to give you the top 10 things that you can do to save money on your taxes. And some of these you haven't heard of because they're brand new, and you got to take advantage of them before the end of the year. This is an action-packed episode, and nobody wants to be paying more in taxes than they have to. So this is specifically for you dentists out there, and Omar does a wonderful job of breaking it down, and he put it all in an ebook for you, which you'll learn more about in the show. Stay tuned. All right, we are live for another episode, and today I have Omar on. Omar, I feel like I know you in real life, even though this is our first time ever virtually meeting. We interact on Facebook all the time. You spend a ton of time there, and we were recently talking about what dentists can do to save money on their taxes. You know, the number one thing that most people don't realize is like taxes are your biggest expense. Your business gets taxed, and then you get taxed on top of it when you take home money. So if you want to save money, and I know dentists love saving money, you're going to be sharing with us today the top 10 tax hacks for 2026. Now, this is specifically for practices over $1 million in collections. You gave us 10 here, and I don't know if we can make it through all of these, but we're going to go over the top 3. And it's really key. This is really important. You have to act on these now going into the new year to be able to take advantage of this. So let's hop into the first one, entity planning. Tell me a little bit about what that means and why most people miss the boat on that.
Yeah, because really, if we want to grow a business, you have to know, like, where am I going, right? Like what's the end game? And a lot of times practice owners kind of jump into like, okay, practice ownership without really having a game plan. Do I want to be a multi-practice owner? Do I want to open one office every year, right? One office every 2 years? Or do I want to have one office that's basically going to be my main source of income, and I'm going to use that to build my real estate, build, mutual funds, whatever stuff? Or am I going to basically have a lifestyle practice? I want to work 3 days a week, and I want to collect X amount, and that's really what it's going to be for me. And I'm going to take care of my kids or my family whatsoever. So entity planning is really understanding where do I want to be and making the right moves, or it kind of blows up in your face. And I'll give you an example. When you have practices, one of the things you'll probably see a lot on Facebook or on TikTok is be an S corp, be an S corp, be an S corp, right? Okay, so we've had clients that come to us all the time that own 2, 3, 4 offices, and they're all S corporations. And I tell them, look, man, I know you just built a brand new office and you spent $700,000 on it, but you can't take any of those deductions. And they look at me like I'm crazy. And I'm like, it's because you were previously set up by your accountant as an S corporation. And you can't take any deductions unless you put some money into the practice. You have no equity, right? So that's the bad thing about an S corp. If S corp is great if you're a one office show, and you're keeping some of the money in the practice as retained earnings, so you can take a deduction for it. So if my bank balance is $100,000, I've got $700,000 of loans, which is typically the case, I'm upside down $600,000, which means the IRS says you can't take any of your losses. They should have set up as a partnership, right? Now that partnership could be you and your wife, you and another company that you own, right? You could own the company 99% yourself, 1%, say you have another company that you use to make your own partnership with yourself almost, right? And
then how much savings are we talking about? Just like, because I think that's a good one right there.
Tremendous, right? Because if I have $500,000 of losses I want to take this year, so I can use that money to then offset my next practice I'm going to open next year, right? 500,000 times 35% is over $167,000 in tax savings.
Ton of money.
Correct.
Yeah, see, it's so interesting because a lot of times you'll go to a tax professional, right? Or somebody who's helping you, whatever, somebody's doing your books, and you're like, hey, should I do this? And a lot of times they'll just say yes. But what I've noticed about people who are number crunchers like that, they'll follow the logic, whatever you give them, but they're not thinking about the 700 other roads and how each of those are impacted. So I, as a business owner myself, I've made so many tax mistakes where I went and asked like, hey, what if we do this, this, and this? And they were like, yeah, you can do that. That's legal. And so I do it. And I get to the end of the year and then I'm like, oh man, I just learned this. Why didn't we do it this way? And they go, oh, you can do that too. That's a good way to do it. And I'm just like, why didn't you like, it's so frustrating.
Yeah, as a strategist, you want to almost act like a doctor, right? You want to try to figure out, okay, what's the treatment plan? And you can't figure out a treatment plan until you figure out what's causing the issue, right? And so each doctor, we talk to so many different doctors. Everyone's different. Some people want to have multiple offices. Some people want to sell the DSO in 4 or 5 years. Some people want to have 10 offices. Some people are like, no, just one office is fine for me. And I'm trying to build up enough wealth so I could have real estate or have something else on the side. I'm not chair side. So that depends on what your entity structure should be like. Those are the questions you should be answering when you first, open an office, or really 6 months before you open an office, so that way you're not too late. The worst thing to be in is if you you're planning on getting that big deduction and you don't have a deduction. Now you open a new office, but you got to put $100,000 of taxes to the IRS that you're planning on not having to do. We know that can suffocate an office, and that money should be going to marketing. That money should be going to, getting that practice off the ground as quickly as possible. And now you've suffocated the practice, and you've got a tax bill that you're not ready to pay, which puts you in a really bad situation.
Yeah. Okay. So if you want these top 10 list, he put together 10 of these, and they're really good. Some of these I was like, oh man, I'm going to steal some of these for myself. And if you want that, it's right down below. You can download the whole thing. We're not going to go over all of them. I just said, give me a couple good ones. Let's talk about the next one: owning your building versus cost segregation.
Yeah. So and so it's plus cost segregation. So this with the new tax bill that just got passed, right? Now 100% bonus depreciation is back on the table, and this is huge. So a lot of you guys are having the opportunity to buy a practice, and some of you guys can actually buy the real estate with it too. The dentist is retiring and selling the property with it. If you buy the practice and the property, and make sure you always have 2 separate LLCs when you're doing so, right? There's something called a cost segregation report, which basically is a fancy word for it. It's an engineering report. Some engineers come out and look at your property, and they basically, instead of taking the entire lump sum of your building and say it's $1 million and saying, okay, we're going to deduct it over 39 years, depreciate over 39 years, they basically put into buckets: 5 years, 10 years, 15 years. So your wall is 10 years, right? Your furniture or fixtures will be 10 years, and they start divvying it up. Now, all of a sudden, what's going to happen is $1 million property that I bought is now $300,000 of that $1 million property is now deductible the first year. So that's a $300,000 tax deduction versus a $30,000 tax deduction. So here's where owning your own property and real estate come into play. So the IRS has a rule. It's called a grouping election. If you own the property and the business that's in that property is 100% run by you, right? The IRS says, I'm going to treat you as one activity. So think of it as the fact that I could take a loss on a building and apply that loss against my dental practice. We've literally had doctors that basically bought a practice and the building, wrote off the practice portion and the building portion, paid no taxes for 2 years, saved that money, bought the second location, did it again.
What's the reason not to do this? It almost sounds too good to be true. Why wouldn't everybody do that?
I mean, we did that with our own property, right? We have our own office building here, and we didn't pay taxes the first year we bought the property because it offset all of our practice income, right? There's no reason not to do it, because it's really just, if I give you a deduction and I said, hey, Gary, I'm going to give you this deduction, I'm going to divide it over 39 years, and I said, hey, I'm going to take a big chunk of that and you could take it today, there's no reason not to do it. Even if you sell the property tomorrow, some people are like, oh, well, I'm going to pay tax on that money that I saved. Well, then you do a 1031 and you just buy another property with the savings. That's how the rich play the game, right? And it's all about having the right advisors.
Yeah, it's assets and leveraging those assets for either for money or for depreciation. Okay, so this next one, I don't know what this means. Section 199A deduction. What is that?
That's your qualified business income deduction. And so when if you're married, it's around 350K. If you're 350K, 57K. If you're single, it's around 157-ish, right? If you're in that income threshold, then and you own a business, then 20% of your business income you get as a deduction back. So if I made $200,000 on my dental practice, I get $40,000 as a free tax deduction, free. And this was part of the tax bill that just got passed again this year.
So this one's just a semantics game of what you labeled it, basically.
This was part of the bill that got passed and extended. Right now, here's the cool thing. Like let's just say that my practice is at 400K. Shoot, I don't get a deduction. Right, I miss having this free money. So now the game you go is, you say, you play the game is, okay, what deductions can I take now to get below that 350 threshold? So you get double benefit for it, right? If I'm at 400K, I'm going to go find myself $50,000 of deductions, and I'm going to pick up another 60K deductions because now I qualify for the new 108 deduction, right? So that's where you start doing some income modeling, right? We do that with our clients every year around October, and we say, hey, go buy this, and this is your number. You want to go, hey, go shopping, right? But go shopping for stuff that's going to make you money, right? You need a new scanner, you need some new hand pieces, you need a new chair, you're going to expand to the fifth op. It's going to pay for itself because you're right there. You're basically
getting free. You're either going to pay the government or you're going to buy some new equipment.
And imagine how upset somebody would be if they looked at their tax return and they were like, man, I missed this free deduction by $7,000.
Wow.
Right. I missed it by $7,000. Yeah. So I was at 160. Yeah.
And let's go over one more of these because I think people, I see this one in Facebook groups all the time, putting your kids on payroll.
So we get this one all the time. We're like, all right, my kid is super cute. Here's a picture, right? Don't you think she's super cute? And I want to put her on payroll. So this is one of the things where we always tell clients the fact that, okay, we want them to basically have legit jobs, and you can't really, everyone really says, hey, I'm going to take a picture of my kid and put it on the website, and that's going to be, a write-off. Still, the fact that if you're flagged by the IRS, you're going to have a pretty hard time defending it because, again, I could take as much as everyone's kids are really beautiful.
They're not. Some of your kids are ugly out there, but he's just being nice.
Where you could go to and download a picture of a kid and stick on your website for like $100, right? And so you can't go and pay your kid $14,000 as a model when I could go to a gallery and just get $100, download and unlimited right to use that picture on my website.
So let me give you an example. Like I pay several of my kids like $1,000. Now that money comes back to me because I'm their parent, and it's at a very low tax bracket. And then of course I use it for stuff that I would be buying for them anyway. So it's a write-off. But then I have them do stuff like shredding, cleaning, those kind of things. Is that all legit?
Yeah, that's all legit. Yeah. So once your kids are, like 7, 8, 9 years old, and you can actually tell them do these certain things, and you can track the hour. I mean, if you have, we have some clients that have 3 or 4 kids, and they're between the age of 14 and 17. I mean, that's massive because you put each of them on payroll for whatever 12, 13 hours a week over the weekend. Every weekend, come in and do all this stuff, clean stuff, sanitize stuff, right? That's $50,000 of tax deductions right there, free. Right. So do it the right way, but don't put your kid as a model and pay them $14,000 for a couple of pictures on the website. Right. That's not going to fly.
These are really, really good tips. Some of these, there's several others on here. So if you want all this information, it's all downloaded. He put together a whole ebook, and he did this just for our listeners, which I really appreciated. I was like, hey, can you put together like your best tips and give them away? And he was like, absolutely. So I appreciate you doing that. They're right down below. Omar, if someone wants to reach out to you and say, hey, I want to take advantage of some of these things, but I don't know how to do it, or my CPA told me to do the opposite of some of these things, what's the best way to get in contact with you?
Just you go to our website, dentalcpausa.com, and go on our website, and you'll fill out a quick form, and it'll give you a link to a calendar where you can book an appointment automatically. So it's super smooth.
Great job. Thanks so much for coming on, and appreciate you sharing these great tips.
Awesome. Thank you for having me, Gary.